Hey, Renter Tires, it's Adam Schroeder here with another episode flying solo. And today I wanted to talk about a couple different things that are important for investors to think about whenever you're, actively looking to purchase a real estate property, whenever you're considering it. So I wanted to touch on a few things that you need to keep in mind as you go through the process. And right now, one of the things I think that's most important is to look at your different loan options. It's very, very simple for an investor to just say, I'm going to get a conventional loan. I'm going to, just fill out the paperwork, do that, take my government backed securities. I've got 10 of them. Let's just get this loan and move on. That is a very tempting thing to do. It makes sense for a lot of people during a lot of times of life, during a lot of times of investing, but sometimes they don't make sense. And so this is one of the things. I know we've talked about other loan options, but I want to look at options you have available out there that might make more sense for you as an investor than just going the full dot conventional loan. One of the things that we talk about a lot that you'll hear is the DSCR loan, the debt service coverage ratio loan. And this is just quite simply a loan that is based off of the property itself, requires a lot less paperwork on your side, and it allows you to get a loan that you can put straight into an entity, which will allow you to keep it off of, your debt to income and keep it over here with your entity, providing you with immediate asset protection if you do it that way, because it is never in your name. And you don't have to worry about doing any quit claim deeds. You don't have to worry about, potential due on sale clause, even though that is not really a thing that ever happens, but it just kind of alleviates any concerns you might have. Now, usually, that involves an interest rate that's 0.75% higher or so, sometimes 1%, sometimes half. But in today's world, that's not the case. In today's world, many times it's on par or better than your conventional loans, which is just insane in a lot of ways. But it is. That's just the case. Whenever we look at the rate buy downs, whenever you're purchasing a property with us and utilizing some of the rate buy downs, you will see that after just a little bit of points being added to the loan, your DSCR rate is better than it would be if you went the conventional route. Now, you have to remember with DSCR loans, there is a floor. So let's just say that floor is 5.5%. You can, throw money at buying your rate down until you get to 5.5%, but then you can't add anymore. It just won't work. Now, with conventional loans, a lot of times you can go lower, especially if you're doing something with us that involves a forward commitment. We can get you down to even as low as 3.99 I've seen. So you've got a lot of different options, but that does cost quite a bit of money. So there's the DSCR option that allows you to beat out conventional, put it in the entity, never let it hit your DTI, your debt to income. But there's also, your DSCR loan that is a 30-year amortized with 10 years interest only. We're seeing a lot of people take advantage of this loan. And the big reason that people are taking advantage of this loan is quite simply, it allows you to get a really low mortgage payment. I will grant you it is only interest, but here's the thing, the beautiful thing about this loan is it gives you a lot of flexibility. Just because it's an interest only loan that will boost your cash flow doesn't mean you only have to pay interest. You can always make principal payments that will lower your interest payment. But you get to decide if you want to do that. You get to decide some months, maybe you don't want to put principal towards it. Maybe you want to put some principal towards it. Maybe you want to put a lot of principal towards it. It is up to you. It gives you the flexibility to do whatever you want with it. And not only that, but a lot of times people are using this to improve their debt service coverage ratio. And when you improve your debt service coverage ratio, it improves the rate you can get or the points you have to pay to get the rate that you want to get. So it allows you a lot of flexibility out there. Now, some people hear interest-only loans and they start getting scared because that's what they think. They start thinking about 2006, 2007, 2008, and the Great Recession. But there's a big, big difference in doing it now versus doing it then. Back then, you were doing a interest-only loan and you were also putting no money down, which meant that whenever it reset, if you wanted to refinance, you had no equity at all in the property, which meant that you had to come with 20 or 25% down, and those people didn't have it. Some because they just didn't have it saved up, some because they lied about their income or their savings because they were no doc at all loans. But that's not the way that we're running mortgages anymore. Whether or not you ever pay down principal, you have 25% equity in that property day one because you are being required to put down a down payment. You have 20% if you're doing it that way and you have a higher interest rate. You've got equity in the property day one from the property whenever you're doing this loan product. You are having to show reserves. So you are not in a situation that you were in 2006, 2007, 2008. So you need to get that out of your head as you keep looking at these loan products and see what makes sense for you as an investor. Talk to your lender. Talk to your rent to retirement strategist. Figure out what makes the most sense for you, because there are so many different loan products out there that it's crucial you understand each one and understand how you can utilize it, how you can protect yourself, how you can put yourself in the best financial situation as you move forward. Maybe a conventional loan makes a lot of sense for you. Maybe a DSCR makes a lot of sense for you. Maybe an interest only makes a lot of sense for you. Every single person is different. Every single person's goals are different. And that is why it is crucial that you understand your options and you figure out how you can get where you want to be in the time frame that you want to do it in. So I want you to consider each and every one of these things as you go through the process of building up your portfolio. But the fact of the matter is, look at your loan products, but you have to decide, you have to take action, and you need to be getting these loans because you need to be building up your portfolio so that you can reach the financial number, the financial freedom that you're looking for. The other thing I want to talk about is prepayment penalties. A lot of times people are getting worried about prepayment penalties, being 5 years, 3 years, 2 years, 1 year, and they say, but I want to get rid of my prepayment penalty. That scares me. I don't want to be locked into a loan for, 3 years, 5 years. What if the interest rates go down, right? What if I could have gotten out of it and now I have to pay a penalty because it hasn't been 3 years? Well, the fact of the matter is, if you're getting into the deal today and you're getting the right terms, who cares what your interest rate is? Maybe during this time, interest rates plummet and it makes sense to refinance. Yeah, you might have to pay a penalty, but you can always get rid of that prepayment penalty whenever you're doing your original loan. You just need to know it's going to change your interest rate. The shorter your prepayment penalty is, if you're doing a DSCR, if you're doing, a lot of different loan products, conventional loans don't have it. But if you're doing a non-conventional loan, they're likely going to have prepayment penalties. If you look at our rate buy-down sheets that we have, they are all based on your loan having a prepayment penalty, whether it's 3 years or 5 years, somewhere in the middle. There's step downs where it's like 5, 4, 3, 2, 1. There's 3, 2, 1s. It just depends on the loan product. But you need to talk to your lender and see what your options are. Because sometimes if you take a longer prepayment penalty, you're in a situation where you can get a lower rate. And maybe you're getting a 5 3/4 rate. Well, then what rate is it going to make sense to start, thinking about refinancing? It's going to be pretty low. And are we going to get down that low in the next 3, 4, 5 years? Let's be honest. Probably not. Probably not. But in those 3, 4, 5 years, you're going to be getting rent growth. You're going to be getting equity growth. And so you're still going to be in a good place in 3, 4, 5 years whenever it's time to, get out of that loan and, pull out equity, sell the property, refinance just to get a lower rate, whatever you want to do. But don't be afraid of that prepayment penalty, because you are likely going to have this loan for a few years regardless. Because remember, refinances are not free. You're having to pay closing costs on it. You're having to pay for a new appraisal. You're having to do a lot of the things you have to do during the purchase process. Really, the only thing you're saving money on is an inspection on these refinances. So they are not free. And so you want to make sure that you're going to be holding these loans for a few years anyway, 2, 3, 4 years, pretty much guaranteed. So a 3-year prepayment penalty, who cares? Who Who cares? Interest rates, you can almost guarantee, aren't going to be, super, super low like they were during COVID during the next 3 years. 4 years, 5 years, maybe we're down a little bit lower. But remember, if you take a 5-year prepayment penalty, your rate's going to be lower. And so the likelihood is, let's just say you get a 5.75. The likelihood is, you've got to drop your interest payment or your principal payment, your PITI, quite a bit to make your refinance make sense. The likelihood is you're not going to be there in 3, 4, 5 years for it to really make sense. So don't be afraid of taking that prepayment penalty put on your loan. Just do not be afraid. Just look at it, figure out what your plan is for the property. Now, if you're doing something where, let's just say you're doing a creative finance deal, you're hoping to get out of it in 1 or 2 years, then yeah, it makes a lot of sense to eliminate the prepayment penalty or make it a 1 year and just take a higher interest rate on the loan. No harm, no foul. You just make sure that you're not having to pay a lot at the end whenever you're selling the property, hopefully, to your tenant. And so keep that in mind as you go through it, that don't be afraid of them. I hear a lot of people complain saying, "Oh, I don't want a prepayment penalty." Well, they can be your friends. They can help you improve your returns a lot because they will improve your interest rate a bit as you go through it. Every single time you change something in your loan, it's going to impact your rate up or down. And if you add prepayment penalties, it improves the loan product that you're getting in regards to interest rate and those sorts of things. So it will increase your cash flow whenever you do that. So don't be afraid of it. That's what I want to say. We hear a lot of people complaining, but just because conventional loans don't have prepayment penalties doesn't mean they're necessarily the best choice for you in today's world. 90% of real estate investors miss key tax savings by overlooking deductions. Flipping houses, managing rentals, or growing your real estate empire? Make sure you've got experts in your corner, especially when it comes to taxes. That's why we turn to Nevada Corporate Headquarters, the experts who help us reduce taxes and set up our real estate LLCs. With 35 plus years of experience and 17,000 5-star reviews, Nevada Corporate Headquarters helps you manage properties across states, navigate tax laws, and protect your assets, all with a real estate LLC. Visit nchinc.com/RTR to schedule a free real estate LLC formation and tax consultation. Plus, receive a free guide to safeguarding your assets. Managing your rentals shouldn't take over your life. That's why Rent to Retirement partnered with HEMLANE, a platform built to help you self-manage with confidence. With HEMLANE, you can advertise on top sites like Zillow, Apartments.com, and more, automate rent collection and lease tracking, access 24/7 repair coordination and support services. It's a platform that scales with you, providing the tools and support you need at every stage of your rental journey. You'll get 25% off your first 2 months when you subscribe using the link in the show notes. The other final thing I want to touch on is all of the incentives that are out there for property purchases today. If you go on to renttoretirement.com and click on our inventory, you will see that we have a ton of different options out there for investors about how you can utilize money that's part of your loan or that's part of your purchase price and use it in a way that benefits your strategy. You need to talk to your rep. You need to schedule a call with us to really understand the opportunities that are out there. These are in growing markets with increasing rent, with increasing appreciation. And these are deals where it's not a one size fits all thing. Every single property, if you have a 5%, 6%, 7% benefit that you can utilize, there's a lot of different ways you can utilize that incentive to make your deal make the most sense for you. And that's why we are here to help you with it. Because you don't just want to say, I've got 5%, throw it at my rate. For some people, that makes a lot of sense because their plan is all about cash flow rates, locking it in, getting it set, forgetting it, right? But maybe you're looking to be in for less money and you can get in for 25% down, but take 5% back. So really you're only in a property for 20%, but you've got the rate that 25% gets you, right? Maybe you want equity because you're going to be refinancing in the future and you want to pull that equity out and have it tax-free, because pulling out money in a refi is not a taxable event that happens. So you've got a lot of different options out there, and we are here to help you plan that out. We are here to understand your goals and give you a third-party recommendation. We're not, making you do it, but we're going to say, hey, you've told me you want to achieve this goal. Based on that, this might be a really good option for you. And then obviously we want you to run the numbers for yourself and figure out if what we're saying aligns with what you're thinking, so that you can make the best possible decision for yourselves. So we are here to help you. It can get very confusing. I will fully admit we're having to continually train ourselves and everybody here about all of the different options with all of the different teams, because each team has something different going on, some different incentive being added. It sometimes changes weekly. It can be a very overwhelming thing for investors to come in and just jump in from day one. So please talk to us, figure out what options are out there, because this is a time we have not seen before. We have not been in a time where you've been able to utilize 5, 6, 8, 10% of a purchase price towards buying a property. It just hasn't existed. So get out there and look at the inventory and see what makes sense for you. Talk with your rent to retirement rep. Head on over to renttoretirement.com. Click on the turnkey inventory and see what we have. See what incentives are out there. Some of them are even leased. So you're getting cash flow from day one. You're guaranteed to get the cash flow. Your rent rates are going to be there. Obviously, we're getting rent rates from our property managers that we're confident in. But if you've got a tenant in place, you know exactly what it's going to be, right? So take a look, talk to your rent retirement rep to see what makes sense for your portfolio, and we will help you find the best fit for it, and we will make sure that you're introduced to the best possible people to help you achieve the goals you have to achieve. So get out there, look at the inventory, make a plan. Thank you for spending the time to educate yourselves today. I'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.